This video provides an overview of forecasting for companies with multiple divisions. We'll begin by looking at when it makes sense to separately forecast the divisions and then move on to an example. Let's first look at a couple of examples of when it is most important to make the separate segment forecasts. Recall that estimated value depends on future growth, profitability, and discount rates. It is always a good idea to forecast revenues for major segments. What is less clear is when to separately forecast segment profits and assets. A rule of thumb is to make segment forecasts when both growth and profitability vary across the segments. Now for the examples. These forecasts are based on the average historical growth and profitability metrics. As a baseline, suppose that both segments grow at 10% a year and have the same profit margin of 15% and have net operating assets that are 70% of revenue. There are also corporate expenses that run at 3% of revenue and corporate assets that are 10% of the total segment revenue. As a benchmark, when the segments have the same growth and profitability, the forecasted free cash flows based on total company profits, denoted by the red dashed line, are nearly the same as those based on the divisional profits, denoted by the solid blue line. When the growth rates differ between the segments but the profitability is the same, the total company and division-based forecasts are again nearly the same. Similarly, when the growth rates are the same but the profitability differs, the total company and division-based forecasts continue to be the same. When the high profit segment is growing faster, the division-based forecasts yield higher cash flows, which is more accurate than the company-based forecasts. It reflects that the overall company is becoming more profitable. Conversely, when the low profit segment is growing faster, the division-based forecasts yield lower cash flows than the total company forecasts. The division-based forecasts accurately reflect that the company is becoming less profitable. Now let's develop a specific example for Westlake Chemicals, which has two major segments, vinyls and olefins. We'd like to have enough information to forecast revenues, NOPAT, and net operating assets. The available historical data depend on what the company provides, which can vary. Westlake Chemical provides quite a bit of detail for its segments. As is typical, Westlake reports historical segment revenue. Westlake also provides a lot of information on segment profits, including after-tax profits. We also see information on Westlake's operating assets, but nothing on segment-level operating liabilities. We can see that the two segments have different growth rates and different profitability. This means that it will be important to separately forecast them for valuation. For example, we see that a Wells Fargo analyst report includes separate segment forecasts of sales and EBITDA. Note that the analyst forecasts higher EBITDA to sales margin for the olefins than for vinyls. This is consistent with the olefins' higher profit margins. There is not enough detail to forecast cost of goods sold, receivables, and so on by segment. In this case, in a valuation model, you would forecast segment-level EBITDA, then build up the rest of NOPAT, and build the net operating assets at the company level. To get a more developed example, let's take a closer look at Westlake's disclosures to see what sort of data are available. I rigged the example numbers to get a similar forecast to what we saw in the Wells Fargo report. A good place to begin looking for data is item 6 in the 10K, which provides data for the past 5 years. Here we see data on sales volume, which suggests that we could build revenue forecast around sales volume. Westlake's segment details provide the sales in terms of dollars. From here, the basic formula we can work with is volume times price. For historical data, we see the segment sales in volume, and we can use that to infer the historical average prices. Once we have revenues, we can then forecast EBITDA, which we can typically do using a simple assumption of operating expenses as a percentage of sales. We repeat this process for each segment. This table presents the resulting forecast and a comparison to the Wells Fargo forecast. We should, of course, subject our forecast to the usual reasonableness checks. As with company-level revenue forecasts, your segment forecast will depend on the available data and the segment's business model. Fortunately, companies are required to provide some segment details in the financial statement notes, and companies typically provide additional segment details when they're relevant to understanding and valuing the company. This completes the video on forecasting segment results. As an exercise, look up the earnings announcement and conference call for a company with multiple segments and see what information its management provides.